All right, so you want to be a better investor. So, what better way than to learn from the best teacher of investing ever? And no, I'm not talking about me. Of course not. I'm talking about Benjamin Graham, the same mentor that taught Warren Buffett how to become a centy billionaire. And that's what we're going to do today. If you go to the Columbia Business School website, you can actually find Benjamin Graham's lectures from when he was a professor at Columbia University in the 1940s. So we have 10 lectures here, and we've already gone over two of these lectures in our channel. And today we're going to be going over the third one. In the description, we have a link to the playlist if you want to watch the other ones, but we're going to dive right into this. Before I do, I just want to say that in the description, as well as the playlist, we also have a link to the StreamYard, which we're doing right now. It's a live stream. So if you want to join on while we're doing a live stream and ask us questions, feel free to jump on and do so. The only thing is, I'm going to be doing the entire lecture first. And when I'm done, I'm going to look for questions or comments and answer them. I won't talk to anybody in the live stream itself. I'll close the live stream and then we can talk from there, just to keep everything safe on the channel and keep it away from any kind of trolls or stuff like that. But I'm going to do the lecture and then we can answer some questions or stuff like this. So make sure to take notes, whatever you need to do, but let's get into it. So this is the third lecture, just like I said. It's really hard to put kind of a category on it. I decided to attribute war accounting to it. And in it, we're going to talk about LiFO, net deduction method, dividends, and actually another topic, which I'm going to talk about, which I'm going to call as, I don't know, territories or something like this. But let's just get into it. It'll be easier if I do. So like I said, the first thing he talks about is this concept of LiFO. And if I pull up Investopedia real quick and probably make it a little easier than what Ben Graham said, LiFO means last in, first out accounting. And it's a way that you can attribute, it's a thing that you can attribute to your inventory. To make it really easy to explain, imagine you bought a box of nails, and excuse my drawing, I'm not the best artist. And if you bought a box of nails for $1, then you waited some time, and as time went on, the prices of nails went up. Then you went and purchased another box of nails for $5. Right now, oh, that was a bad five. Sorry about that. Right now, you have about $6 worth of inventory. Now, according to last in, first out accounting, the last box of nails you bought was $5. And when you go to sell your nails, you're going to assume that the $5 is what was, or the $5 worth of nails is what was sold to the customer. So there becomes an actual case of what happened and then an accounting kind of case. So let me just write actual, what actually happened, and then the accounting based version of what happened. So we have our box of nails, that's $1, and a box of nails, that's $5. Now let's pretend you sold the box of nails that was worth $1 and you sold it to the customer for $10, we'll say. That means you made a profit of $9 in actuality. However, when you do your accounting, you can use last in, first out to assume that the $5 box of nails was what was sold. So in accounting, it looks like you sold your $5 box of nails for $10 and made $5 in profit. Now, why would you want to do this if that's not what happened? Well, first of all, the reason why we get to do this is because, as you can imagine, inventory can get pretty complicated. You're not just buying 2 sets of boxes of nails. You can have very, very many sets of boxes of nails. And then you can have way more things than just boxes of nails. You have nails and screws and everything in between, right? So you have to pick something to kind of best represent what's happening to the company. Now, why you would want to do this is because your reported earnings, instead of being $9, which actually happened, would be $5. And the reason why you'd want to do that is because you have to report your income to the Treasury to pay your taxes. So if you wanted to tell the Treasury how much you had to pay in taxes, Wouldn't you want it less so that way you'd pay less in taxes? Of course. So if you tell the government you only made $5 in profit, you're going to be taxed on $5 rather than the $9. So not only do you get to keep the actual $9 of that happened in actuality, but you only have to pay as if you made $5 in profit. So it really works in your favor. Now that's just the earnings. There's actually another component, and that is the inventory component. So let me just kind of clean this up real quick so I can show you what happens to inventory that makes it also beneficial. So again, in actuality, bloop, bloop, you're going to sell your $5. I'm sorry, you're going to sell your $5 box of nails. Just kidding. You're going to sell your $1 box of nails. Okay, so your $1 box of nails gets sold just like we did before for $10. This is what happens in actuality. Your inventory in actuality is $5. When we do last in, first out accounting, we assume that it was the $5 box of nails that was sold, meaning that on your balance sheet, it looks like you have $1 of inventory. So it looks like you have less inventory, which means you're very conservative on your balance sheet. You actually have more value than what's actually being reflected. So not only do you get to report less earnings, you get to save on taxes, and there's more value that's hidden in your balance sheet. So all around, it's a really good thing. Let me just clean up this canvas so we can move on to the next thing. So that's what Ben Graham is saying in A, B, and C. Inventory, earnings, and taxes. So to give you an example, there's a company he wanted to point to called the Federated Department Stores. And in 1942, they used last in, first out to enable them to receive a tax credit, well, essentially save on their taxes, by $2.5 million, which is awesome. Until you get to present day when they kind of run into trouble. And the fact that essentially, as you can imagine, boxes of nails might be easier to track than something like a department store. So if you have, oh, this is going to be a very bad shirt, but imagine that's a shirt. That's a shirt. I don't know what's up with my shoulder pads. Let's just say I'm a fashion designer. All right, so you bought this shirt for $1. You bought this one for $2. I'll stop drying shirts and say you bought another one for $4, but then sold the $2 and then bought one that was $8 and then $9 and then sold the $1. And, it gets much more liquid and everything happens so much faster. It's really hard to track everything that's going on. So what department stores end up trying to do is what's called this, I'll highlight it for everyone, index of retail price changes. So they can kind of track everything so that way they can do appropriate accounting. But the Treasury was saying that you can't do that, or you can't use LiFO in this instance because in their discretion, it wasn't appropriate. So they had to go back to first in, first out accounting, which wasn't favorable to them because they were able to save a lot of money before with LiFO. So he just wanted to say how important LiFO can be. And then he moves on to say that the significance of LiFO is pretty interesting. And this is how he kind of ties it to my general kind of topic that I think he's going at in this lecture, and that is wartime kind of accounting. So he said the significance of LiFO is interesting when you reflect upon it, because it's very similar to the wartime amortization of plant facilities. Now, we've covered previous lectures before, and he didn't use the term plant facilities. He used emergency facilities, I think. That's what he was referring to. I'm going to keep using plant facilities just because that's what he says here. But if you're trying to tie these videos or lectures together, I would assume that it's emergency facilities. But anyway, which we discussed 2 weeks ago. There you recall the companies had the opportunity to write down their fixed assets, which were recently acquired, to zero, and to get the benefit of tax credits, the effect of which, however, was to reduce their earnings somewhat. So it's identical to what we're talking about with LiFO. So you save a great deal of money in taxes, but reduce your apparent earnings somewhat. Okay. And that's pretty much the conclusion of LiFO. And he moves into the net deduction method and more wartime misrepresentations of earnings based on what's reported and what's probably closer to reality, what he calls true earnings. And to do that, he uses the example of a company, a rail company called Northern Pacific. He said, When you look more closely at Northern Pacific, you will find that the main factor affecting the company that does not affect other companies is its large interest in an affiliated railroad, which is not shown in its income account, except in the form of dividends. Northern Pacific owns 48.5% of Burlington. Now, the Burlington is rather paradoxically bigger and much better railroad than Northern Pacific. So I'm assuming they bought Burlington when it was really small and just outgrew Northern Pacific. But because their interest is so, I'm going to say small, they don't have to report it in its income statement. So it's got this hidden value that you don't see in what's reported. In addition to that, Northern Pacific also owns 50% of a rather substantial railroad system called the Spokane, I think that's how you pronounce it, Portland, Seattle, which before the war had no earnings power, but after the war has had substantial earnings. So in the past, it wouldn't have mattered too much, but now it's making a ton of money and we don't get to see it because it's not reported, excuse me, just like with Burlington. Add to this another factor, and that is that Northern Pacific has a land department, and I'll highlight that for you. Northern Pacific has a land department which has been productive of rather substantial income over the years. All three of these things aren't being shown, but how much are they actually influencing the true value of the company? Because it would be one thing if we don't see it and it's producing like $0 in earnings, but it would be another thing if it were like 100 times over what we're seeing. So Ben Graham does the math for us. He said that if you take the average earnings over the 5 years, you would have found that the hidden equity was about $26. Let me just highlight that, $26 a share. In addition, in those 5 years, making a total of $53 that has gone back to the stakeholders, which is incredible because that means the hidden equity was just about half of what was actually reported. So clearly, there's something to be said of his method and looking deeper into the earnings based on what's shown. But here's the thing, though, right? Earnings can't just disappear. Like, where did they go? There's got to be somewhere where it's reflected. And Ben Graham says that when you look at the balance sheets, you can see the effect of the increased earnings, in addition to an increased dividend. But we'll just look at the balance sheet right now. He said that you can see a reduction in funded debt, a reduction of 36% in fixed charges, which essentially meant that they became more efficient, and a considerable increase in working capital. So essentially, even though you don't see it in the earnings, that the balance sheet is getting much better. So there are ways to see it, even if you don't originally did, and it's not on the surface. But then let me just keep going. He said, and if these conditions weren't good enough for you, if you believe what Wall Street believes about the current industry analysis, it could be that the rate environment that they're in could produce more substantial earnings for them going in the future. Just to put a cherry on top, I guess. So this is what he uses to say is the importance of looking at the railroad on a consolidated basis rather than on the basis of earnings as a report. There we go, right? But if you look at one company, it's not enough, he said. And I've seen Warren Buffett do this too. You can't just look at a single company without looking at its competitors because you don't know what their durable competitive advantages are. You want to understand if this moat that they have or this business, beneficial business environment that they're producing earnings and stuff like this can continue, or if competitors are going to come in and just sweep away all these margins. So he said he wants to look at competitors, and probably the best one is Northern Pacific and Southern Pacific. And then he chides, there is a relationship in names there that would make the comparison a natural one. I thought that was funny. Okay, so what are we saying when we try to compare the two companies? On the surface, on reported earnings, it looks like Southern Pacific is way better than Northern Pacific. He said in the years 1936 to 1940, Southern Pacific averaged $1.27 per share, while Northern Pacific had a small deficit. Now, I should have told you before, but Northern Pacific sells at about $19, while Southern Pacific sells about $42, which means there's like a 2-to-1 ratio between Southern and Northern Pacific rail companies. Okay, so when you look at these earnings per share, you would think they should be in a 2-to-1 ratio. Otherwise, there's some kind of discrepancy, right? Well, he's saying $1.27 for Southern Pacific and a deficit for Northern Pacific. That doesn't add up. In the 5 years after that, in 1941 to 1945, it is about a 2-to-1 ratio. So it makes more sense there. However, in the 8 months after 1946, Southern Pacific shows $3.86 against 74 cents for Northern Pacific. So way better than the 2-to-1 ratio. Southern Pacific is looking great compared to Northern Pacific. And the only problem is Ben Graham doesn't agree with you. Well, I agree with the reports. And we'll see why. The first thing that he wants to say is that there seems to be some kind of swaying when it comes to taxes. When he looks at taxes, he can see that Southern Pacific had a tax credit of about $19 million, which is even more than the earnings reported for that period. Meanwhile, Northern Pacific had a small tax payment of its own. So is this tax benefit, this tax credit, swaying what's actually happening to the company? Well, what if you look at how much is earned before taxes? Ben Graham did the math for us, and he said for the 8 months leading up to 1946, Northern Pacific's earnings before taxes would be $4.60, while Southern Pacific would have a deficit of $1.20. So the earnings that were reported originally were being heavily swayed and pretty much carried by this tax credit that Southern Pacific was able to nab. And Ben Graham will go into the reason why in a second. But this is what Ben Graham shows us. And if we continue, he says, oh, no, actually, he told you already, I think. Okay, so he essentially said that Southern Pacific did really well on a tailwind during the war environment, and they were able to accumulate this $19 million, which I'll highlight for you, this $19 million. But he doesn't believe it's sustainable, and it's got nothing to do with the current operations of the company. Moving on, he says that analysis, of course, calls for much further probing into the situation, okay? Because it's not just taxes that's carrying the company, or that is going to be the deciding factor. You want to look at the operations of the company on its current basis, right? So he said you need to ask yourself why it is that you get diverse developments in different periods that we are studying. Because he said that even if you look beyond the years where they had the tax credit, Northern Pacific's just kicking Southern Pacific's butt. And what he finds is that Southern Pacific in 1946 apparently lost control over its expense ratio more seriously than that had happened to Northern Pacific and to Burlington. As a matter of fact, the Burlington has been doing a very nice job of maintaining its net earnings, even under the unfavorable wage and rate situation, which we've had in 1946. So essentially, the entire rail industry has been hit with a headwind just because it's in the industry it's in, and certain companies are navigating better through it. Southern Pacific isn't handling it that well, whereas Northern Pacific and Burlington are. For whatever reason, they're able to. So if you study the Southern Pacific figures over a period of time, you'll see that, of course, the Southern Pacific derived great advantages out of the war. Okay, so he said it here. I'm sorry, I skipped ahead. I didn't say spoiler alert, sorry. It increased its surplus and its working capital considerably during that time when they had this massive tailwind. It decreased its debt a great deal, and it cut its fixed charges by about 20%. And the figure is not quite as good as the decrease shown by Northern Pacific and the Burlington combination. So coming out of the war, Northern Pacific and Burlington are doing much better. But he says there's more to it than even that. He said that you want to look at the net deductions method, which is found in his security analysis book. On about page 163, there's a heading here called Methods of Computing Fixed Charge Coverage. Essentially in this, I guess, chapter section, Ben Graham was trying to figure out a margin of safety for railway bonds. And he said that if you look at rails and the bonds, they have a fixed cost when you're trying to predict how much earnings these bonds are making you. You want to look at their fixed costs. But there's also a section of variable costs. He calls fixed costs fixed charges. I'm just going to call them fixed costs. But then there's these variable charges. Now, it's really hard for us to determine what variable costs truly are. So Ben Graham wants to figure out this kind of ratio between what's fixed and what's variable to figure out essentially how many the relation between the two, to figure out, how do I say this? Essentially, he wants to see how well the company is reflecting what's fixed and what's variable, and how many times the fixed costs can cover the variable cost. For example, if you had $1 in fixed cost and $9 in variable cost, to him, that's pretty uncertain. He would rather see $9 of fixed cost and $1 of uncertain or variable cost. So he's trying to find this ratio, essentially. And he's got all the math here. He doesn't show it for the specific. Oh, I guess he does, kind of, but we're just going to take his word for it here. I'm not going to do the math in front of you. Essentially, when you look at the ratio and you find the fixed costs of Northern Pacific, and I'll put an F here for fixed costs, and then you find the fixed costs for Southern Pacific, you would immediately say, okay, Southern Pacific's doing better. But if you look at the fixed costs and rentals and equipment, okay, so I'm going to call this variable costs. And you would assume that the variable costs are fixed, especially because you've seen this been consistent over time and time again, that you would find that Southern actually doesn't do as well as Northern Pacific, because obviously the sum of it is much more than Northern Pacific. And if you look at the ratio between the two, so F to V, essentially, you'll find that there's a greater proportion of fixed cost to the overall cost for Northern Pacific than there is for Southern Pacific. That's what I'm trying to get at, and I'm stuttering through miserably, and that's what he's trying to get at. So he said, when you look at this, Northern Pacific is still doing better. But then he moves on from the net deduction method and starts talking about dividends. He said one very good reason why Southern Pacific sells so much higher than Northern Pacific is because it's paying dividends at the rate of $4 and Northern Pacific is paying dividends at the rate of $1. Now, today, I don't believe that's the case. In fact, we probably perceive dividends as less valuable today than we did before. But keep in mind, I want to expand your horizon here. There might have been a different environment for, we'll say, the taxes on dividends, or maybe for us, but there might be like the tax advantages for the companies on dividends. Like I don't know that off the top of my head. So dividends might give more value to the companies than they do now. Right now, we see it as kind of a tax inefficient way to give to the shareholders. Typically, you would probably rather see the company reinvest the dividends they would ship out into the business and produce a higher return than I would. And then if I want to take a dividend, I can just sell some of the stock and it'll be more tax efficient. But essentially, he's saying that when he sees dividends here in this time in 1946, stocks will be more expensive or do better because they have a higher dividend. Now, he gives a couple examples as to why. The first one he points out was actually this Reading in Pennsylvania example, where even though earnings were pretty much the same, the company that paid higher dividends traded for a higher price. And he says it's not limited to rail companies either. He's seen it with insurance companies. So New Amsterdam Casualty Company and United States Fidelity and Guarantee were almost identical in every respect, except one paid a higher dividend than the other. And as a result, the stock traded for a higher price. So Ben Graham is starting to see kind of a pattern here, essentially. So the interesting thing is when you think that a company that has a higher dividend is trading for a higher price, the question that comes up is whether you can expect in the normal course of events that the dividend policy will adjust itself to the earnings and that eventually the market price will adjust itself to earnings and will not be determined by an arbitrary dividend policy. To put that in plain English, essentially, okay, so if higher dividends mean higher stock price, then what if we just increase the dividend? Even though we don't have the earnings, does that mean we're going to get a higher stock price? And Ben Graham says that's actually a difficult question to reach a conclusion about. And he wants to talk about it at a different time. I haven't actually seen these other lectures. I kind of do them live with you. It's kind of been real fun. So we might see him talk about that in the future, but we don't get it on this one. So let's move on to the last topic he talks about. And it's actually a question that a student brought up. So one of the students says, one of the appraisals that I hear is that since Southern Pacific is so largely in the Southwest, Texas, and a territory that is growing much more rapidly than the Northwest territory, that some rail analysts are strong in their preference for Southern Pacific on the basis over Northern Pacific. And this is a really fascinating question, and I really want to tie it into what we're seeing in present day investing, kind of patterns I've seen with people that I surround myself with. So Graham answers this by saying there's undoubtedly the impression that the future of the Southwest Territory is better than that of the Northwest Territory. In the most recent figures of developments of gross earnings, I would like to give some figures on that, which would show how these companies have developed over the last 10 years in relation to volume. And I'm not going to read them for you, but essentially he just agrees. He agrees with the student that the territories are doing well and the companies are doing well. But at the very bottom here, this last paragraph that I have highlighted is really the important one. He says the question that one would raise about those figures is the extent to which they have been reflected through the impact of war conditions since 1941 and whether or not they'd be expected to continue in the future. So, yes, the pattern kind of lines up, but is it sustainable? Ben Graham seems to believe that it says right here, he doesn't know what the answer is. And this is where it really defines your circle of competence, how well you're able to understand the industry and how it'll affect the companies and how well you understand the companies and how they'll adapt to the industry. But he said, furthermore, I don't know how important such changes with regard to gross earnings may be in the final earnings power of the railroads. So then he says, well, take this, for example. Even though, yes, we've seen so much more growth in the territory in the South and with the company Southern Pacific, in the last part, in the last 8 months of 1946 leading up to the class, after the Southern Pacific has had its tailwind from the post-war era, if you look at the EBITDA, so the earnings before income taxes and depreciation, you'll find that Northern Pacific's EBITDA was 27 million, which was nearly 20% of its gross. However, Southern Pacific only had about 30 million, which was about 9% of its gross. So if you look at how well the company is doing, based on removing the factors that could have been affected by the tailwinds of the war, that's unlikely to keep going in the future, it looks like Northern Pacific's going to be doing better. The explanation for this is Ben Graham has said, let's see, the explanation of that is that, so the reason why Northern Pacific is starting to do better is because of the transportation and maintenance expenditures that he talked about earlier. Essentially, Northern Pacific, like I said earlier, has had better control over its wages than Southern Pacific. And to conclude this entire lecture and move on to what I want to talk about, Ben Graham said, the conclusion that was asked about the general future prospects of one territory as compared with another is certainly very relevant to analysis of railroad securities. Yet I must say that I have found in my own work that you can count very much more dependably upon differences of value which can be established from the earnings and expenses picture than you can on those which seem to be inherent in the possibilities of the different territories. What he's saying here is it's better, in his experience, to base your analysis on the companies themselves rather than anything that has to do with the territories. So yes, the South was doing better, but he's saying that it was probably due to some war conditions. But the businesses, in terms of the businesses themselves, Northern Pacific's doing better, and he projects that it'll carry the stock better than Southern Pacific will. And that's pretty much it for the lecture. And what I wanted to do to tie this into what we're seeing today, essentially, a lot of people are interested in Chinese securities because the Chinese market's been essentially crashing recently. And people have looked at things like the GDP growth of China, for instance, versus the GDP growth of the US, and think that just because China's doing better, it would be a better place for us to put our money because the territory is doing good. And according to what Ben Graham is saying here, he's saying that you'd be way better off, in his experience, basing your analysis on the companies themselves. Just because China is doing better doesn't mean you can't find a company in the US that will outperform China, even though it's in a poor territory or something like this. So that's pretty much what I wanted to tie it into. So that's it for the lecture. Let me just jump into the StreamYard to see if anybody has any questions. Matt Henson, oh, thank you so much, man. I really appreciate that. And I love your feedback on Baba. That was really kind of you. Yeah, I really appreciate that. I think I've thought about it a lot more, and it's highly likely you're right. And I might even retract it. I don't even know, but I think I'm gonna give it some time to feel it out some more. I really appreciate your comment. And then Ava Lucas, anyone with Chase Business? I don't have Chase Business, so that might be someone else to answer that. But thank you all for watching, and until next time.